Welcome, dear investors and friends. So, what are we going to talk about this month? I think we've seen a lot of action on the macro front. We have the war, which is still persisting between Ukraine and Russia, which continues to put pressure on commodities, on supply chains, and that headwind for companies and markets, in my belief, will continue for a couple of more months. On top of that, we've had central banks moving towards normalizing interest rates and hiking rates in view of the inflation that we've seen. And I think that while a 50 basis point hike by the Fed was expected and delivered, I think finally the Reserve Bank of India also jumped in mid-cycle and hiked rates by 40 basis points and also increased CRR or squeezed liquidity by 50 basis points. And therefore now all central banks are clearly moving towards dampening inflation or responding to the inflationary expectations which are building up in the economy. We believe that that is to be expected, and these will create volatility in the short to medium term. But I think it is necessary given the kind of extraordinary liquidity and monetary stimulus that was put in place because of COVID. So, on one hand, if the economy is going to normalize because of COVID, then we should also expect that liquidity and interest rates will also normalize. In my view, as I said, while it may create some headwinds in the near to medium term, it does not alter our very positive view on markets, because our belief is that the markets from here on will be driven less by liquidity and more by earnings growth. And therefore, coming to earnings, this month I will discuss what trends we are seeing in two sectors which are large and important sectors, not only from a market perspective but also from our portfolio perspective. First, let's talk about IT services. As you all know, we have been bullish on IT services, and we do have a reasonably good exposure to IT services in our portfolios. We continue to see that the demand growth and the order books of IT companies continue to grow from strength to strength. We believe that this is a secular trend, and despite quarterly variations, we believe that these are companies that we would want to be invested in for a reasonably long period of time. But if we were to parse the trends, the few trends that came to the fore were: demand continues to be strong, especially for offshore. Secondly, we continue to see very high levels of attrition. Most companies have experiencing attrition somewhere in the range of 20% plus. This obviously is very, very high, and there is a tremendous pressure on supply side, and there is also pressure on salary hikes, which we are clearly seeing in the company results. Do we think this is temporary? I do believe that the supply side constraints should abate, but it may well take another year before attrition levels starts to normalize, which means that there will be some pressure on margins. Having said that, most companies have been able to manage margins by either offshoring more or improving utilization. And by and large, while there has been some pressure on margins, most companies have been able to manage margins reasonably well. Coming specifically within the IT services to the ER&D companies, or the engineering and research and development sub-segment of IT, which is where we have a reasonably strong exposure, namely in companies like Tata Elxsi and L&T Technology Services, we believe that those companies have fared much better than the normal IT services companies, and therefore our bet on the ER&D services companies has proven to be substantially right, as they, even within the IT pack, have outperformed. We believe that they are in a sweet super cycle of spending, and therefore the ER&D companies will continue to show very strong growth going into the couple of next quarters, and not only in the next quarters but over the next few years. And while we may choose to trim a part of our high allocation to some of these companies, we will continue to maintain a core exposure in our portfolios. The largest sector in the index is banks. And as we all know, in the run-up from the lows of COVID right up 2 years since then, banks in general have underperformed the Nifty. And the reasons are: one, these banks had to take extraordinary provisions for COVID-related write-offs. They had to raise capital and keep buffers. And they also saw a slowdown in credit growth. However, this quarter, almost all the banks have produced, and including NBFCs, have produced reasonably strong set of numbers, largely driven by lower provisions. However, we have seen that there has been some slight pressure on NIMs and margins. However, with the rate hike cycle back, we believe that banks will start to experience pricing power, and especially banks who have a strong liability franchise where they can collect low-cost deposits should stand to benefit. Having said that, one of the reasons, and an important reason that we've been highlighting why banks underperformed thus far, apart from provisions and extra capital that they were carrying, was the threat from very nimble and digital and fintech players. And therefore, one of the differentiating factor while choosing which banks and NBFCs to invest in, we clearly had a preference towards companies that we believe are very strong in their digital capabilities. And hence, within the large banks, as we have said before, we continue to back banks and NBFCs which are digitally far ahead in the curve and are better equipped to fight competition from the new age fintechs, and therefore our exposure to ICICI Bank and Bajaj Finance. We continue to like these two names, and we will continue to increase our exposure to these two names. However, as we see progress on credit growth and the rate hike cycle, we do believe that our traditional underweight on banks may give way to us slowly increasing our exposure to financials. We do believe fintechs and digital will continue to be a continuous threat, and we will continue to back companies that we believe are investing heavily in their digital capabilities. I do believe that both these sectors, IT services and financial services, will continue to be a significant portion of exposure that we will take in our portfolios beyond some of the other sectors, which I will talk about in the subsequent month. But for now, thank you. until we are back next month.